My name is Ryan Fowler, and today we're going to cover the basic types of business entities you can form. So first off, let's talk about the sole proprietorship. This is the oldest, most basic business type you have. It's basically just one owner starting a business. You may register a doing business name as name called a DBA if you want to give yourself a business name other than your own name. You can register that at your local courthouse or county recorder's office. The pros of this is you don't need to register anything with anyone. It's a simple setup and operation. You just set up shop. Sometimes you need a business license. That's about it. The cons are you get no limited liability, no asset protection, no special tax reduction tools. For example, the S corporation can be used to reduce self-employment tax liability. You can't do anything fancy like that with this. Personal creditors can get your business assets, and business creditors can get your personal assets. The next business type we have is the general partnership. Again, you normally don't need any type of special registration. In some states, you can optionally register your general partnership in those states. Basically, two or more people just get together and form a partnership, and you can do a DBA as with the sole proprietorship. In a general partnership, everyone is a manager and can act on behalf of the partnership. But what that means is if partner A does something to get the partnership sued, then partner B, C, and D are liable for partner A's torts. And that's really bad because if you have a partnership with 100 people, it only takes one person to mess up and make all 100 liable in connection with the business. So a general partnership is usually a really bad idea. On the bright side, general partnerships do have charging order protection, which we talk about in another video. We have a video on charging order protection that protects against outside liabilities when a creditor goes after one of the owners of the company. The next business entity we have is the corporation. This is the first statutory entity. That is an entity that is created as a matter of law. It's a creature of the law. It's an artificial person. It can do most everything that a normal person can do, except it's completely separate from you. It is treated kind of as its own separate person in a business context. Corporation its ownership is reflected by stock, shares of stock. They can be freely alienated. You can sell your stock without the other stockholders' consent. You don't get any charging order protection. Again, we're going to talk about that in another section, but charging order protection is a special type of asset protection that's very important your business entity has. If you want to protect your business assets from creditors of the owners, it's important to have that. It doesn't matter if you have a really big corporation like Microsoft with millions of shareholders. Charging order protection is not as important, still important, but not as important. But for small corporations, it can be very important if someone gets sued and they own 51% or more of the corporation. A charging order protection will prevent someone from seizing that ownership in the company. And there's more to it, but that's what we'll talk about for now. Shareholders generally have no liability for business debts beyond their investment in the corporation, so they have limited liability. Directors and officers are often still held liable for personal torts committed while doing business for the corporation, while in the course of business. That's why they have directors and officers liability in insurance. Shareholders may be held liable for business debts if a plaintiff convinces a judge that the corporation is the alter ego of the shareholders. And again, we have another video that talks about the alter ego. It's called Limited Liability Concepts. You'll want to watch that video to see how to prevent a creditor from going after the shareholders for a business debt or a lawsuit against the business because of an alter ego ruling. More on the corporation. It's taxed under U.S. law as a subchapter C or S corporation. What that means is subtitle A of the Internal Revenue Code, which is with regards to income taxes, has a subchapter C that governs tax treatment of corporations as a C corporation. It has another subchapter called subchapter S, and that's why they call these S corporations or C corporations. It's just two different ways to tax a corporation. And you can usually choose to be taxed one way or another, although if you have a corporation with many, many owners, or with owners that are not U.S. persons, and you cannot be an S corporation. There's a few more requirements for S corporation. We won't go into those now. A C corporation tax treatment is good if you have an annual net profit of $100,000 or less, ideally even $75,000 or less. Then you get pretty good tax treatment for the corporation if you wish to reinvest profits into the company each year and grow the company, and it's still a small company. Then C corporation tax treatment is a pretty good way to go. But you have to be careful, because if the C corporation's paying taxes and then you take the profits and distribute them to you, you have to pay taxes a second time on the same profit. So the corporation pays taxes once, if it's distributed to you, it pays taxes again. And that's not good. So again, usually C corporations, corporation pays tax, you don't distribute it, you reinvest it in the company, and if the earnings are relatively low, then you actually pay a pretty low tax rate compared to tax rates of you as a person. The corporate tax rate in that situation would be lower. As a S corporation is a pass-through entity. That means that the owners of the S corporation just pay normal income taxes as if they got income from a job or something like that. They, same type of income tax, and it can be used to reduce your self-employment tax liability with an S corporation. Now, corporations also have what's called a three-tier management structure, and the three tiers are the shareholder, the directors, and the corporate officers. The shareholders can elect directors and other managers of that sort. The directors make big strategic decisions for the corporation, and then the officers, which is the president or the CEO, the secretary, treasurer, like that, they run the day-to-day business of the corporation, and they don't make the big strategic decisions, at least not without the consent of the board of directors. So you have three distinct levels of management with the corporation. This makes corporations more cumbersome to operate than an LLC limited partnership or one of the other more simpler business entities. Also, corporations often have to observe some corporate formalities, and you have these corporate minutes and resolutions anytime you make a decision, so it makes it more cumbersome. For that reason, and because of the fact that corporations don't have this charging order protection I was talking about, it's usually only a good idea to form a corporation if you plan on having a public offering. Otherwise, consider a limited liability company, an LLC, which may also elect to be taxed as a C or S corporation or partnership or disregarded entity. Or sometimes you may want to do a limited partnership or a limited liability partnership. Next, we come to the limited partnership. There's two classes of partners with a limited partnership. There's the general partners and there's the limited partners. General partners manage the partnership. They have no limited liability for business debts. So if the business goes under and the business doesn't have enough assets to pay for business debts, guess what? General partners are on the hook. Limited partners cannot manage or represent or bind the company. They can work for the company as employees. But because they don't manage the partnership, they do have limited liability, and they're not held personally liable for debts of the business beyond what they put into the limited partnership to capitalize it. Everyone here gets charging order protection. Again, to make a long story short, if someone sues you, they cannot get assets in the corporation, cannot force a distribution of assets from the corporation, cannot gain control. The limited partnership. Cannot gain control of the limited partnership and cannot become a limited or general partner because of this charging order protection. Corporate stock, you don't get that benefit with corporations. So it's an important type of asset protection that corporations don't get. Limited partnerships get it. Limited partnerships are sometimes used for estate planning. They call these family limited partnerships. There's an estate planning strategy called a valuation discount, where you put assets into a limited partnership, and all of a sudden those assets are worth less for estate planning purposes. It's usually worth between 20 to 70% less. How much less depends on a wide variety of factors. Ever since 2009, there are now certain circumstances they used to be able to use this valuation discount strategy for, they no longer can. it's now more restricted to bona fide businesses, not just a limited partnership that holds investments. Probably won't get a valuation discount for that. You can still get valuation discount for a bona fide family business, however. Limited partnerships, there are sometimes taxes levied on LLCs that are not levied on limited partnerships. Most LLCs, in most states, this is not the case. But for example, an LLC in California, depending on how much it brings in annual gross receipts, can pay north of $12,000 of a certain type of tax, where the limited partnership pays a flat rate of $800 no matter what. So sometimes a limited partnership is better than an LLC. And also there's a very few states where there is potentially better charging order protection for a limited partnership than with an LLC. So for one of these two reasons, you may occasionally form a limited partnership instead of an LLC. Otherwise, as we're going to see shortly, the LLC generally more flexible, powerful, and a preferable entity to use, and not all, but most cases. By the way, the evaluation discount strategy, if you do your LLC right, you can do it for an LLC as well as a limited partnership in certain circumstances. Now, limited liability companies, relatively new. Limited partnerships been around in the U.S. for well over 100 years. Well, LLCs only since 1977, started in Wyoming. We call it a hybrid entity because it gives you the best benefits of a corporation and the best benefits of a partnership, and just kind of puts it together into kind of a super entity that has a lot of benefits. A limited liability company is not a corporation, and a lot of times people call LLCs limited liability corporations. They think it's a corporate entity. It is not a corporation or a corporate entity. It is specifically an unincorporated business entity with limited liability for all members. And we call owners of the LLC members, owners of a partnership or partners, owners of a corporation or shareholders. Now, some members may manage, you may have one of the members manage the LLC, you may have all of them manage, some of them manage, you may have no members or owners of the LLC manage the LLC, and you hire someone who is not an owner to manage the company. So you get a lot of flexibility with LLCs as far as who can manage. It's a lot easier to change the managers of an LLC without sacrificing asset protection generally. Without sacrificing asset protection. A lot easier to do this with an LLC than with a limited partnership. Remember, a limited partnership, the managers have no limited liability. LLC, they do have limited liability. Everyone who is a member of an LLC gets charging order protection. So again, that's a very good thing. LLCs can pick their poison with regards to tax treatment. They can be taxed as a disregarded entity, which is how sole proprietorship is taxed. They can be taxed as a partnership, an S corporation, C corporation. It depends on how the company is structured, and also for C or S corporation treatment, you file a certain form with the IRS, Form 8832 or 2553. It is a two-tiered management structure. The members generally will appoint managers, and then the managers run the company. And so it's a lot simpler and easier to do than with a corporation. You don't, oftentimes you don't need to follow the corporate formalities and all these resolutions and minutes that corporations have to file. You normally just have the manager sign a contract. You don't need a resolution or approval by the board for him to sign a contract or anything like that. So it may still be a good idea to follow some formalities so that the limited liability of the LLC is respected, but it's often not necessary or required. Because of this, there's less reasons to pierce or disregard the protection of an LLC. Some states specifically say you don't have to follow corporate formalities for your LLC to have limited liability. And there's no state that says that you have to follow corporate formalities. But guess what? Corporate law generally says you have to follow corporate formalities. So that is a good thing for LLCs. LLCs are usually the most flexible, best business entity formed. Not always. As mentioned previously, there are situations where you may want to form a corporation if you're going public, or a limited partnership if you're in a state where the LP has a stronger charging order statute, such as Florida, or other reasons like that, maybe tax reasons. Occasionally, not too often. Now, these two entities, the LLP and LLLP, Our niche tools are not used very much, but occasionally I've set up a few LLPs this year, for example. With an LLP, limited liability partnership, everyone gets limited liability, but everyone's a manager. So with a limited partnership, you have some that manage and some that don't. Well, here everyone manages, but everyone has limited liability. One partner is also not liable for the torts of other partners. This might be a good choice in Florida because it's a lot cheaper to form an LLP than a limited partnership, and it's a lot cheaper to maintain it. The state fees for limited partnerships are very expensive in Florida, pretty cheap for LLPs. You get great charging order protection for LLPs. It's stronger charging order protection for LPs and LLPs in Florida than LLCs. You'll see a lot of law firms and other maybe CPA firms, other licensed professionals use LLPs. An LLLP is a limited partnership where the general partners get limited liability. Most of the time you just want to do an LLC, which is everyone gets limited liability. Every once in a while you'll find a good reason to do an LLLP instead of an LLC. And there's only a few states that offer LLLPs. A lot of states, they don't even have legislation that allows you to form it. So that's this video, and I hope you've enjoyed it.